How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about the FDIC's proposal on broker deposits. Like, what does it mean? Is it a good thing? Is it a bad thing? And then also connected to that is another article that I want to look at, basically looking at the presidential election and how that can basically affect the regulatory landscape, particularly as it relates directly to this and basically fintechs. Like, how are fintechs going to be regulated? How is that vendor partner relationship with banks going to be regulated? And what comes next? So again, just to kind of give everybody a little bit of context to this conversation before we jump into the articles is I did a couple of episodes on the bankruptcy of Synapse Financial Technologies. That was basically a fintech company that had partnered up with a number of banks and non-banks around the country to provide all kinds of, kind of like different services, payment networks, channels, a lot of different things that basically help those banks to provide a lot of services to their customers, basically utilizing what's called the BaaS model, which is the banking as a service model. And with the failure of Synapse, and the main bank that got involved with that was Evolve Bank and Trust, and they've just had all kinds of problems there. There's like $85 million of customer funds they can't find, and this all leads to the question, like, well, who's going to hold the bag for this? To the fintech. The fintech's bankrupt and gone. Like, so there's nobody at the fintech that's going to hold the bag for it. So what are the banks going to do? Are the non-fintech companies, like I think it was like Chime, one was called like Yoda or something. Like, there's a couple different ones I had never heard of, but they are they gonna pony up to reimburse some of this money for their customers? So we shall see. But it kind of, in the wake of all this collateral damage, we now have the FDIC coming in and saying, hey, we need to do something as it relates to these fintech partnerships, and this is kind of what they came up with. So both these articles today were written by Yizhu Wang, who is from S&P Global Market Intelligence. Again, the first one here is FDIC proposal would classify more BaaS deposits as brokered, not core. And so the FDIC rule proposal would end a common banking as a service practice that allowed banks to count deposits originated by fintech partners as core and require them to classify the funds as brokered. So regulators impose more restrictions on funds gathered with the assistance of a third-party deposit broker because they are viewed as riskier and less sticky than core deposits. BaaS deposits are viewed as brokered if a fintech program uses multiple bank partners. However, if the fintech program is partnered with one bank, the BaaS deposits can be considered core thanks to an exemption referred to as the exclusive deposit placement arrangement. So the FDIC's proposed rule seeks to eliminate this exclusivity exception, and it could have a far-reaching impact on BaaS practices given the broad use of this exemption. Yes, I would render that. So I think that there's this whole conversation right now, like, are brokered deposits good or are they not good? And, there's a lot of history here around broker deposits. So back in the financial crisis in 0809, what they found in the research was that a lot of the banks that failed because they had this over reliance on broker deposits. And that's basically how they were getting, like, 90% of their deposits were all coming in through third-party broker deposits. And that basically the reason why they failed was because all those broker deposits got sucked out the door. So there was this kind of like taboo on broker deposits. They only wanted you to keep like a small percent, like say like less than 10% of your deposit base in broker deposits. And that's kind of how things have been for the last 13, 14, 15 years. But then we had we had this little banking crisis that you might have heard of last year, or we had a couple banks fail. And the interesting thing they found in their analysis there was that broker deposits were strong. They were good. The one type of deposit that the banks could depend on in this liquidity crisis was the broker deposits. They proved very sticky and wouldn't go out the door. So, but like I said, you kind of get into this thing of like, well, what is it? Are the broker deposits good? Are they not good? Like whatever, I happen to think broker deposits are great. I think they're fine. But I think you should have an overabundance of broker deposits? No. Do I think it would be a big deal if a bank had 15 or 20% of their deposits in broker deposits? Like, no, I think that would be fine. But again, we're in this kind of tug of war here. And like I said, but let's continue on here. But again, I just wanted to say that to kind of give people a little context as to the background of the history here and what has led us to where we are today. So, okay. Many of those banks are using an exclusivity reason for these deposits not to be treated as brokered deposits, said Matt West, founder of Xenios, who advises on BaaS arrangements. Although some of the fintech companies have seen the benefit of having a backup bank partner, it is currently being discussed more than adopted in practices, especially for smaller BaaS programs. A goal of the rulemaking is to address risks in bank fintech partnerships, FDIC Chairman Martin Gruenberg said during a board meeting July 30th. The risks were illustrated by the recent bankruptcy of middleware vendor Synapse Financial, which Gruenberg called a deposit broker. Synapse played a middleware role connecting 4 bank partners with a dozen fintech applications. As Synapse filed for bankruptcy in April, the parties had difficulty matching transaction records. It led to end users losing access to their funds for months as the banks worked to balance out the ledgers. There also appeared to be a deposit shortfall that left users worried. The rulemaking has spurred a debate. Opponents say it mischaracterizes fintech risk as hot money and adds regulatory burden to the BaaS banks. Proponents of the proposal say the broker deposit classification is necessary to reflect its higher risk. And then here we go. And then not clear-cut broker deposits. Some argue that the BaaS deposit. I'm gonna kill me saying the BaaS. Deposits do not have the same hot money characteristics of traditional brokered deposits that concern regulators. So according to the liquidity manual of the OCC, banks pay up for broker deposits to raise large amounts of funds quickly, in part making the funds highly rate sensitive. This is true. But in a typical BaaS relationship, the selling point to depositors is rarely just higher yield, as the fintech platform can attract end users by offering other services such as payments and an easy-to-use interface. Also, the economics are far more nuanced depending on how the bank and the fintech split revenues and responsibilities, and the fintechs are usually driven to build product niches to retain users and build a long-term relationship with the bank. I would say a lot of these fintech deposits are actually the opposite of hot money, said Matthew Bornfriend, a partner at Troutman Pepper. I think a problem with this proposed rulemaking is the FDIC asserts that these are hot money and less stickier, more likely to run away from the bank than core deposits are, but they don't actually provide any evidence or data to support those propositions. Classifying those funds as broker deposits adds regulatory restrictions, which will only exacerbate the partner bank's stress when things go wrong. If a struggling depository institution is no longer considered well capitalized, they may not accept, renew, or roll over broker deposits unless they apply for a waiver from the FDIC. This requirement would unnecessarily deprive a source of funding of the BaaS bank. So consider it like a de facto run, but it's a run by operation of law. So very interesting there. Not clear-cut core deposits. So it is reasonable to expect BaaS banks to be careful of unusual liquidity strains. In the case of Synapse, countless end users became anxious to pull their money out of the fintech apps after the chaos. Those deposits will eventually leave the partner banks and weigh on the bank's liquidity. A key factor making core deposits sticky is that money outflows are not necessarily correlated, but a large fintech partner could be in a powerful position to determine the destination of millions of deposits or become a single source of stress, triggering money outflows. And then it concludes by saying, a change in posture. Broker deposit classification is only one of the many gray areas in BaaS. Many practices in BaaS seem to fit somewhere in the traditional banking glossary, but can be interpreted differently. So, so again, I want to go back to, where I think this sentence hits the nail right on the head. Opponents say that this proposal will mischaracterize fintech risk as hot money and adds regulatory burdens to BaaS banks. Yes, it absolutely will. Proponents of the proposal say the broker deposit classification is necessary to reflect its higher risk. Now, let's go back again to this liquidity manual here. Banks pay up for broker deposits to raise large amounts of funds quickly, in part making the funds highly rate sensitive. So here's the thing. Could the banks basically pay up for these fintechs to bring in large amounts of funds quickly? Yes, they could. So technically that could make it could make it highly rate sensitive, because you could raise a lot of money quickly through these fintech partnerships. And depending on how quickly or how urgent the need is, banks may be willing to pay up to get it. In which case, like I said, like in the case of Synapse, they were working with like 12 different banks, and they could decide where these deposit funds were going to go to. They could switch it from one bank to another, I guess, depending on who would pay up. So this technically would meet that classification, but it's like, so I think it is an interesting, like I said, it's an interesting thing here to look at this. And I think that this is going to make for a very, very difficult debate, because again, this proposed rule here for how to, how we're going to classify deposits from these fintechs. That's only one aspect of this. The other aspect of this is what we're going to get into here in a second, is the kind of regulatory aspect of this. So let's look at the other article just for a second, then we're going to come back to this. So this is U.S. elections have potential to reshape the fintech regulatory landscape. So if history is a guide, the results of the U.S. presidential election in November can dramatically shift the regulatory landscape regarding fintech companies. Between the Trump and, well, now Kamala Harris administrations, regulators have shown different risk appetites when it comes to connecting fintechs with banks. Granting fintech bank charters is one clear difference. So while turning a fintech into a bank adds a source of complication to the safety and soundness of the banking system, regulators appointed by Donald Trump during his presidency were inclined to emphasize the benefits of promoting competition and serving the underbanked. They had been more experimental with developing special charters or issuing interpretive rules catering to fintechs and cryptocurrency companies' needs, and actively approved fintech's application for charters and fintech's acquisition of banks. In comparison, current bank regulators tend to hold any bank charter applications to the same standards under the existing regulatory framework. I do think this is an area where there's likely to be some change between the administrations. It's quite clear that there have been very few bank charters issued under the current administration. However, it remains to be seen if fintech's interest in bank charters ramps up again. To a large extent, fintech's previous zeal for a bank charter is now more rationalized. The proliferation of banking as a service makes it easier for many fintechs to capitalize on deposit and card products by partnering with a bank instead of being a bank. A lot of these fintechs have learned that buying a bank, being regulated, is something for which they are woefully unprepared, said David Sandler, co-head of investment banking in the financial services group at Piper Sandler. If Vice President Kamala Harris wins the election, the industry should expect a continuation of the policies and messaging of the current Democratic-led administration. Yes, absolutely. Unless some significant disruptions or economic events force a shift. And then you have this kind of whole argument of innovation versus consumer protection, Credit Card Competition Act at stake, the crypto banking question. And so it goes in there. So here's the thing here. I did not like, I'm not a fan of all these kind of different charters that are out there, like the ILC, the Industrial Loan Corporation loophole. I didn't like a lot of these different, I was not a fan of a lot of these different charters out there. I think that, like, if a fintech wants to become a bank, if they want to buy a bank, whatever, like, that's fine. Then you're gonna submit to all the regulation and oversight that any other bank in this country has to go through. Why wouldn't they? But then the article, the sentence in here appropriately says, like, I do think, or no, what he says here, a lot of these fintechs have learned that buying a bank, being regulated, is something for which they are woefully unprepared. And yes, I would absolutely agree with that statement. I think that a lot of fintechs found out really quickly that, like, they couldn't believe how much regulation that a typical bank has to deal with. It is crazy. It's a crazy amount of stuff. And, like I said, I mean, banks have learned to live with it. They've learned to deal with it. They've also been doing it forever, so it's not that big. But if you go from kind of like 0 to 120 miles an hour, that can be pretty jarring, right out of the gate. So again, I think that but I do like I said, I do like some of the, like, in other words, right now under the Biden regime, you've got, it's just like one regulatory thing after the next. I mean, they're just, all the, like, the ESG stuff. And then they're coming out and they just want to, like, attacking the Federal Home Loan Bank and all this other stuff. Like, it's just, you can't get a startup bank through right now. If you want to merge with another bank, it takes 2 years to get a deal done. It's just, I mean, it's just ridiculous. What's happening right now under kind of the Biden regime. And I think a lot of this stuff would go away under a Trump regime, but they would, and I think they would cater more toward fintechs and cryptocurrencies. However, I think the reality is the fintechs and especially the cryptocurrency world, sooner or later, they're going to have to deal with some level of regulation. Like, that's going to happen. They're going to have to deal with that. But I think that at the same time, you're going to get, you've got basically a stark contrast, not a little contrast. You have a stark contrast between the administration that's currently there and the potential regime. If Harris wins, there's basically going to be no change. All the stuff that we're currently seeing is just going to continue right on down the pike. If a Trump administration comes to be, you'll see a dramatic difference there. And then again, this all plays back to fintechs and ultimately what happens with the broker deposits rules here. Do these fintech companies, do they get more heavily regulated in terms of what happens with the banks and that kind of management of that vendor partner relationship? So we'll see there. But again, this is bringing up a lot of debate right now in the banking world. I think this is going to become a hotter topic in the months ahead, because, like I said, it's not just this one rule on classifying of the deposits. It's the whole BaaS model. Like, does the model work? Is it okay? It's the managing the vendor relationship between the bank and the fintech. It's an overall regulatory question. We're in the middle of this election cycle, so there's a lot here that needs to unfold in the next couple of months. I mean, do I necessarily agree that these should be classified as broker deposits? Not necessarily, but I will say I could also see why or how they could be, because I pointed that out a few minutes ago, how they kind of do meet the definition of the OCC as far as what a broker deposit is. So again, there's there's a lot. I think there's a lot there to be hashed out in all this. So but I will keep an eye on this, and I will bring this back to you guys. I would love to get, if anybody follows, there's a great investment banking firm out there called FinPro, which is located down in New Jersey. Don Musso, who's is a friend of mine, a guy I love to death. But Don does great. He's got a little podcast thing. He does all kinds of webinars. I would definitely go check out FinPro. He's been talking a lot about this particular subject recently. He's got some great takes on it. I would definitely go check him out. Matt Miller is another great guy over there at FinPro. Definitely go. I would follow these guys on. They're both on LinkedIn. Check them out, and definitely good people to follow. So, but that's it. So if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please make sure to leave your comments down below. And like I said, we are on YouTube, Rumble, and all major podcast platforms. Please check out some of the other episodes on the channel, and I will be back to see everybody again real soon. Thanks a lot.